$50 is an idiot number, pardon me, because one, if those two $50 highs had occurred in the last few years, okay, I'd say maybe it's important. But they occurred in 1980
Yep.
and in 2011. Those are ancient years, money supply growth between those times. If silver matched those same price levels, factoring in the decay in the money unit, silver would be in the hundreds of dollars. And frankly, I think when the silver gold spread breaks out, you're probably going to see in the next couple quarters after that silver move well up into the hundreds, maybe even 200. Because if you factor out the money unit issue, you'd be $200.
Recent market activity across the commodities sector has begun to mirror the early stages of major historical bull cycles, setting the tone for what analysts see as a structural shift rather than a temporary rally. With renewed strength across energy, metals, and raw materials, investors are increasingly watching the precious metals space for signs of confirmation. Michael Oliver argues that those signals are now emerging with unusual clarity, particularly in the behavior of the silver-to-gold spread, a metric that has quietly built a multi-year base and is now approaching a decisive breakout level. While spot prices have moved steadily, Oliver emphasizes that momentum indicators beneath the surface have already crossed thresholds that typically precede major trend reversals. Michael Oliver explains that this technical backdrop aligns with gold preparing to break out of an 11-year range when measured against the S&P 500. Historically, such events have unleashed multi-year advances in both gold and silver, but silver has almost always been the more aggressive of the two once the spread confirms. He points to past cycles, such as 1979 and 2010, where silver didn't simply rise, it accelerated violently after long periods of underperformance. Oliver stresses that the widely referenced $50 level is irrelevant in today's monetary environment. Adjusted for decades of currency dilution, a realistic value lies far higher. The setups he is observing today resemble those that preceded copper and lead's transition into entirely new price realities, moves that unfolded quickly, forcefully, and with little opportunity for latecomers. Looking forward, Michael Oliver believes the market is on the verge of a similar regime shift for silver. Long-term momentum structures across multiple timeframes already show breakout conditions, suggesting intent long before price confirms it. Once the final threshold is crossed, he expects silver to reprice sharply, potentially into the triple-digit range, as decades of undervaluation unwind. With the broader commodities complex strengthening and capital quietly rotating into real assets, Oliver sees this moment as the beginning of a multi-year advance, one in which silver may ultimately outpace every other major commodity. Now, we present the clips from Michael Oliver's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
What it shows is week-to-week closes. Remember back in 2020 when gold and silver surged from a March low up till late 2020, silver doubled in price, basically, and gold went up 40%. So naturally, silver spread shot up. It outperformed gold. But since then, remember, they went into this range-bound situation since 2020 highs in gold. In fact, it was just above 2,000, and it's like stayed there for a couple of years, with the worst drop being 20% in price. But it basically went into a range. But in that time, silver and the gold and silver miners retreated marginally, staircasing, while gold went sideways. So they underperformed. And you can see on that spread chart that silver underperformed gold during that time. Not that it didn't go up in price, it did, but just went up less than gold, okay, until recently, of course. You can see on that chart that there's a green line on that top chart, which is the spread. And you get above 1.31%, and you blow a multi-year ceiling off that spread. And we argue when that event occurs, and I bet it occurs pretty soon after gold breaking out versus S&P, you're going to launch further and dramatically silver versus gold, so that silver will take your breath away compared to what gold is doing on the upside. And silver, we know, is very cheap in relation to gold historically. And I think you could go, in a heartbeat to 2%, which is nearly a doubling from where you are now, around 1.26, and more likely over 3%. Well, think about that. Let's say gold goes to its normal 8,000, another eightfold, okay? And let's say you assume that's all it's going to do, which isn't, by the way. It's going to go a lot further, but let's just assume it gets there. What's three times that, okay? Silver will take your breath away.
So just
Go ahead. I'm sorry. 1.31. You've hit it so perfectly, like with to the decimal over the last 3 years, has been the peak. Now, when I run momentum of that spread, we're at that structure already, even though the spread is not up at 1.31 or 3.2 to break out. It's at 1.26, but momentum of that spread is already at that pending triple top breakout. So again, momentum is saying, yep, it's going to happen. Okay. But what's so interesting is that gold's about to blast through an 11-year wide base versus the stock market. And coincident with that, silver says, okay, I'm back. Okay. All at once. And by the way, if you go back and look at the 79 explosion in silver, where, been going up for a couple of years, and suddenly in 5 months, silver like quintupled. Okay. Or go back to the 2000, like September of 2010, you'd already been going up for a handful of years in silver and gold. But at that point, that spread broke out again, and silver went up 2.5-fold in 6 months. That spread is very important. That silver gold spread. It could lead to dynamics. Momentum of the spread says, I'm ripe to go. I'm ready to go. I'm at the structure. In fact, you may close out above it this week if you close tomorrow out at certain levels just above where you are right now on the spread. Okay. If that occurs, if momentum breaks out, I'm talking like 36-month average momentum, 10-month average, 40-week average momentum, all kinds of long-term metrics say, hey, I'm breaking out, meaning the spread will follow. But whenever you develop structures on spread charts, this is not true with price necessarily, because price everybody looks at. Most people don't look at spread charts. But you develop a clear structure, let's say like a 3 or 4 point downtrend or a ceiling that's been hit 2 or 3 times, okay? You do that with intent. In other words, the action of that market, the spread or the momentum, is saying, I have intent. I'm building a starting gate. And you may not know that I'm building a starting gate because you're looking at price over there. But momentum is saying, I'm building a starting gate, or the spread does, with intent. You don't see those things developed, and then the market says, oh, I'm just going to fade away. $50 is an idiot number, pardon me, because one, if those two $50 highs had occurred in the last few years, okay, I'd say maybe it's important. But they occurred in 1980.
Yep.
And in 2011, those are ancient years, money supply growth between those times. If silver matched those same price levels, factoring in the decay in the money unit, silver would be in the hundreds of dollars. And frankly, I think when the silver gold spread breaks out, you're probably going to see in the next couple quarters after that silver move well up into the hundreds, maybe even 200. Because if you factor out the money unit issue, you'd be $200. And I don't know where you'd be against 1980, maybe 500 in real dollar terms. And by the way, we did a study of copper and lead. Okay,
going back. Study.
Yeah, you've seen those charts.
Yep.
Yeah,
Mm-hmm.
They were in a range of reality for decades. Copper up and down, just like silver, $50, 15, 50, 15, etc. When they broke out of that range, copper did it in late 2005, early 6, broke out of a multi-decade range and quadrupled in price in a few quarters, and then lived in a new reality, violent, yes, big sell-offs in it, but a whole new reality that was 4 times the average price of the old reality. The exact same thing happened to lead at a different time, 2007. But the point was that when they moved out of the old reality and said, hey, this has been ridiculous, I should have been higher anyway, they did it with a whoosh. They probably overshot. That's fine. Markets do that. But when you're undervalued for too long, and silver, we look at the gold chart going back to 1980, what was its high? Then what was the 11 high? Silver still traded around those same price levels? What's going on here? it's going to change and dramatically.
Oh, we get a new technical term for the day. Whoosh.
Yeah, and if you're not there, you're going to miss it. And, Bloomberg Commodity Index, first off, think about price, just that. Go back to 2008. Commodities peaked then. It also made a secondary high in 2011 when gold peaked. Bloomberg Commodity Index in 2008 was at 238. And in 2011, it was at 170 plus. Right now, it's at 108, okay? The surge that occurred from the Bloomberg, when it got below 60 back in mid to late 2020, it was going down from when gold made its low in 2015 at 1,000 something, and it moved up to 2,000, doubled between 2015 and 2020. Bloomberg was continuing down during this 5 years. It went down and got under 60. When it turned up out of that hole, we put out a report that said commodity explosion happening. It doubled. It went up to 140 by early 2022. That was its first statement. Says, okay, I've had enough. Okay. It's still cheap. It's talking 140 versus a 238 in 2008. Okay. It dropped back down under 100. And for the last 2 years, Bloomberg's gone dead in a range about 5 or 10 points either side of 100. You broke out in October of a momentum base that says second wave commencing. Okay. Right now, that was at 106.52 was our trigger number. You've reached up to 110 since then. Right now, you're trading around 108, which is still above the breakout. We think Bloomberg as an asset class is now going to join on the tailwinds of gold. Not that it's always in sync with gold. It is not. Though in the 2000 to 2008 period it was, and even in the secondary high in 11. But it's just breaking out on its own merits. And when you spread it versus the S&P, which we did recently, you can see what looks like a dead base, meaning I'm just not going lower. Okay, I've had it. And if you uptick not much, it says, I'm coming out of here. So that's another asset category that for an investment perspective, let's say the next decade, it's time maybe to get out of the paper bloated bubble and move into the stuff under your feet. Okay, that the grounded reality. Okay,
if you can stub your toe on it, we like.
Yeah. Oh, you can smell it. Okay, cow manure is going to go up as much.
Great.
Michael argues that the market is shifting into a phase in which traditional relationships among metals, equities, and bonds are breaking down, creating an environment ripe for explosive moves in tangible assets. He points out that while equities stumble and government bonds fail to offer their usual protection, gold and silver are beginning to establish fresh momentum patterns not seen in decades. According to Michael, these signals suggest the early stages of a long-term rotation out of financial paper and into physical, hard asset value, something he believes investors will recognize only after the broader stock market experiences deeper stress and household balance sheets come under heavy pressure. From Michael's perspective, the key indicator is how silver behaves once it escapes the technical containment that has held it back for half a century. He believes that when silver spreads and price finally breaks free, they won't move modestly. They'll accelerate in a way that reflects years of compressed potential. At the same time, he warns that deep cracks in government debt markets, commercial real estate, and corporate leverage could push central banks into aggressive bond buying programs, further weakening confidence in paper assets. In that backdrop, Michael expects gold, silver, and miners to regain relevance quickly, with their performance signaling a broader shift into a new monetary era in which physical assets outrun traditional financial benchmarks.
The public will realize that when they realize that, the S&P is only up, right now, about 10% on the year, something like that, maybe, and gold's up, okay. And my buddy down the street, my granddad told me to collect those gold coins, and I didn't do it, okay. It's finally going to realize. But that'll come probably when the stock market really gut hits them. Like not when you're just 20% off the high, but when you're 30 or 40, and they look at all the things on their financial personal horizon. Where they've been late on their mortgage a couple times. They're maxed out on their credit card. They're past due on their credit card. And this is individual stuff I'm talking now. But plus corporations have a lot of stuff that's hidden, that's deep in the commercial real estate markets as well, that isn't obvious. And suddenly the thing on your horizon that kept you smiling was, hey, my retirement account's up on the year. Great, super. I got just enough to retire. And suddenly 30% of it's gone. And you have to say, gosh, I got to go work at Walmart. Okay. That's when panic sets in. And this is not just US. We know Japan, this is a debt crisis like we've never seen.
Global
We're
in
dealing
nature.
with the US government, Japanese government, UK government. We're talking about a crisis in their central banks and their bonds, not mortgages, but government debt. And when we get to the T bonds, we can talk about that because that's a piece of dynamite that is something's wrong there, and they've even acknowledged it. But there's factors out there way beyond an AI bubble that are in play here that will sink the economy in a way where people now can't take what happened in 2008 and 9 again. They're not in a position to do it. And already you can see the breakage in different areas. We're projecting, for example, there won't be a Fed ultimately. There will be an academic rebellion against it because academicians do influence politics. They're sometimes involved in government. But even friends of the Fed have been saying, hey, this hasn't been working very well. They're always late to the game. And when they do finally act, like lower the rates or print money, it doesn't seem to work. Their bubble is already broken. But this time we got a dynamite stick because we've got the government debt. We've got, there's a mortgage problem now too. We've got corporate debt issues, especially look at, for example, at RWR. It's an ETF of commercial real estate. It didn't make new highs when the S&P did. It had a rally off the April low, but it just went lame about halfway back to its highs, and now it's rolling over again. That's too big of a sector to have any failures in. And there's some that are close because they're heavily into debt, commercial debt. And we got the government debt. Now, we had the president of the New York Fed, I think his name is Williams, like a week or so ago made a statement. And you don't make statements like this without prior approval. The Fed is going to probably start buying T-bonds, buying bonds, he said. He didn't define it any better than that. And he said his reason wasn't because they want to cut rates. It's not nothing to do with the economy. It's just the, quote, illiquidity. That was his way of sidestepping further questions. When they make a statement like that the Fed is going to print to buy government bonds, where's the money come from? Okay, they're gonna buy it, not mortgages. Back in the COVID event, remember they actually went in and bought ETFs of commercial real estate, commercial debt ETFs, and helped boost that rally. This time we're talking about buying U.S. government debt. What's wrong there, guys? It has not been the 40% alternative. You had this huge drop in the S&P today, and you've had big slabs over the last week. You look at the T-bonds, they didn't even wake up. They didn't rally. What's going on? Just like gold drop versus the S&P, during the 2000, especially starting in 2008, and then especially as gold started to collapse in 2012, 13, 14, 15, XAU collapsed off the page. The gold miners in general, gold and silver miners in general, GDX or XAU, collapsed to effectively zero. I mean, it went, let me put it this way. If you measured XAU back in the 80s, the 90s, 2000 into about 2008, there was a range of performance readings where plot monthly close, XAU divided into an ounce of gold, where it was living in a range from 17.5% of the ounce of gold, XAU, to 30 plus percent. It's living in this like 15% range, up and down, up and down. That was its reality of performance. When the collapse came, it went to 4%. I mean, if that were a price chart, you'd say, hey, is it going to go to zero? Well, of course it can't. They produce the stuff, okay? Since then, you've gone from that 4% low with a couple highs up above 8%. And right now, you're in the 7% area, okay? You ever get XAU out above that 8% again, divide XAU into an ounce of gold. And we've had strength in XAU, since about April, May. They surged more than gold did. Now, recently they've had violence, but they're out above the 2011 high finally. Okay. That spread is firm, but it's not at breakout. You get above that 8% level one more time, you're going to break out of a decade-wide base with the gold and silver miners, because XAU includes both, where there's nothing between you and that 8% level and 17.5%. You look at that spread chart and treat it as a price chart, and you'd say, hey, this guy breaks out, it's open field running. Before you even bump anything, it might be, in other words, you could double and a half the miners versus gold over the next year or so.
With gold performing well. Just
gold performing well, them beating the pants
yeah.
off gold. So my preference is silver, gold, silver miners, then gold, that order.
You know, I mean, it probably doesn't even need to be stated, but XAU relative to S&P, you know, it's similar to...
Similar situation, yes. Mm-hmm. You're right. You're dead right. It's slightly lagged to the gold S&P spread, but it's not far. It wouldn't take a lot for it to produce a breakout month as well.
Yeah, and you can see just in price performance this year, you've got the miners indexes up 100, 120% versus 10, 15% for the S&P. And we have yet to break out, which is the intriguing piece.
Of the spread. Yeah, you're quite right. And when that makes a statement, that's another table pounder, because it says, hey, if you don't want to buy gold, you don't want to buy silver futures, you don't want to buy silver bullion ETFs, you got miners, they have earnings, get checks or dividends. Newmont pays pretty good, I think, and it went from what, 30, 40 bucks to all of a sudden, bang, 90. Mm-hmm. Didn't shock us because momentum said it was likely to explode. But that's the kind of behavior. What if they're undervalued still? Which they are, relative to gold and relative to the S&P. If they break out of those spreads, wow.
If current trends continue to intensify, the silver market is likely to enter a structural phase in which traditional pricing models no longer apply. The growing emphasis on asset-backed securities, combined with tighter control over strategic materials, suggests that silver could transition from a cyclical metal to a priority reserve for both industry and capital managers. As this shift gathers pace, the market may experience accelerated demand that outstrips available supply, leading to persistent upward price pressure and more pronounced volatility. Over the next several years, silver's strategic relevance is expected to rise sharply as governments, manufacturers, and institutional investors compete for limited inventories. This competitive environment could trigger new long-term contracts, restricted export flows, and heightened interest in domestic sourcing. Such developments would likely reinforce a sustained bullish trajectory, particularly if investment flows begin treating silver as a financial hedge rather than a niche industrial component. What's your take on this shift? If you found this analysis useful, make sure to like the video, share it with others, and subscribe so you never miss the next major update. Thanks for watching.